the last person grabs their seat and their pizza, save a slice for me, will you? Vegetarian, please. I'm Scott Hodge, President of the Tax Foundation. Welcome to all of you. Great to have you here this afternoon. We have an ongoing debate at the Tax Foundation. What is going to attract more people to an event, pizza or Chick-fil-A? And on the Senate side, it's definitely pizza. On the House side, it's Chick-fil-A. So I'll let you be the judge of what that says for either side of the Capitol. Maybe the distinguished palates are over here. I don't know. But anyway, I'm glad you're all here. And we've got a great topic here today. And that is the future of tax reform. Kind of a strange topic to have less than 3 months after the historic Tax Cuts and Jobs Act was signed into law at the end of December. But there are a lot of issues here that raise a lot of questions that we wanted to explore. And as you know, the historic Tax Cuts and Jobs Act cut the corporate tax rate from 35% to 21%, making the U.S. much more competitive globally. Individuals all got a tax cut, at least for the next 8 years, along with other major changes to the tax system. And so we get a lot of questions from reporters and friends and say, well, now you've done your job, time to hang it up, right? Time to retire in the tax world. Well, we don't quite look at it this way. I don't think that our job is actually done in large measure because of some of the issues in the tax reform bill. Will make this a topic of discussion for at least the next decade. As a friend of mine says, the tax reform bill was historic, but not perfect. And so there will be a lot of changes that will be forthcoming, but also some issues for us to kind of think about as we move forward. Looking out into the future, what should the tax code look like 5 years from now, 10 years from now, 20 years from now? And a lot of those questions will have to be answered over the next couple of years, especially as so many of the provisions in this bill will expire, bringing up some really heated debates, no doubt, about whether things like full expensing should be extended, at what cost. And what about all those individual provisions? Which ones of those should be made permanent, and which ones should be allowed to expire? We've seen this debate before in Washington, and we know how heated it can be. Now, permanence or stability is one of the primary principles in good tax policy. Taxpayers should know and should be able to predict how they're going to be taxed. Unfortunately, we don't quite have that case. And so we want to talk about how do we think about extending different parts of the tax code and whether or not some should be allowed to expire. And there's really maybe a broader question here that we want to explore. And that is, while historic and maybe not perfect, how close has the Tax Reform Act gotten us toward, I won't say a perfect tax code, but a better one that's more simple, more neutral, and more efficient. And my colleague Scott Greenberg has written a paper that was available for all of us outside the door, in which he's addressing some of these issues, looking at some of the issues that are going to be raised in terms of the expiring provisions, but also looking forward to the issues that the Tax Reform Act may have missed, which it turns out is quite a bit. But I often hear people, we get this a lot, about the tax reform being a once-in-a-generation opportunity. How many of us heard that throughout the entire debate last year? And I get that, from everyone. It's like once every 30 years. I should hope that that's not the case. If we've learned nothing over the last 30 years, the world is not standing still, waiting for the U.S. to reform its tax system. Between the time that we reformed our tax system in 1986 and today, every other country on earth cut its corporate tax rate to be more competitive and to attract capital and jobs away from high-tax countries like the U.S. used to be. So we need to be constantly thinking about how do we keep our tax system competitive in an ever-changing global environment. A lot of states do this, actually. Indiana is a very good example, where lawmakers there tend to come and take a bite at the apple each and every year. And one of the tools that they use is the Tax Foundation's State Business Tax Climate Index, which ranks the business friendliness of every state on about 100 different measures. And so states are able to go in and identify the areas of the tax system that make them less competitive. And so states like Indiana and North Carolina and others keep coming back and nibbling away and trying to find other areas that they can improve to make themselves more competitive relative to the other 50 states. I think it would do well for the United States to have that same attitude. Not just look at this as a once-in-a-lifetime opportunity or once every 30-year opportunity, but as an ongoing process, a growing process in which we're constantly evaluating ourselves like every other business in America evaluates itself constantly to make sure that it's more competitive. Well, we have a great panel this afternoon. I want to introduce our panelists and then have my colleague Scott Greenberg come up. Our first panelist will be Maddie Duffer, who serves as Senior Fellow at the National Taxpayers Union and is the founder and president of Forward Strategies, a strategic consulting firm, a former Hill staffer herself. She's been a longtime spokesman, been on, I think, every TV program in Washington. I've seen her in the green room many times, as I've been in these studios. Our longtime friend, Len Berman, is Institute Fellow at the Urban Institute and co-founder of the Tax Policy Center. I think all of you know the great work that they do over there. Len is also the Paul Volcker Professor of Public Administration and International Affairs at the Maxwell School at Syracuse University. Tried putting that on a business card. He also, along with my colleague Scott Greenberg, ranks as one of the tallest economists in Washington. Is it Evil Sizer? Is he taller than you?
Yes.
He is, okay. All right. Yeah, well, we got some tall economists, and then there's the rest of us. We make up for it in other ways, my wife says. And then lastly is Alex Brill, who's a resident fellow at the American Enterprise Institute. And Alex is a prolific author on issues as broad as fiscal and economic policy, of political consequences of tax, budget, healthcare, retirement security, and trade policies. He's been an extremely busy fellow recently. And Alex was one of you a few years ago when I first met him. He was chief economist at the House Ways and Means Committee under Chairman Thomas back there during some very heated debates on tax policy. You think DBCFT was heated. Wait till you go back to our FISC-ETI debates back in 2004. Alex was right there. Well, let me invite my colleague Scott Greenberg up to say a few words about his paper, and we'll get the conversation started. So thank you for joining us.
Thanks so much, Scott. As Scott mentioned, the federal tax code today is far from perfect, and there's much more work to be done on improving it. Specifically, our federal tax code today is overly complex, economically inefficient, and contains far too many special preferences for specific activities and groups. And furthermore, beyond all of this, the federal tax code isn't stable. There are many parts of it that are set to expire over the next 8 years, which will create uncertainty for businesses and households. I cover all these issues in a recent paper from the Tax Foundation, Tax Reform Isn't Done, which you can find a copy of outside and on our website. But I wanted to go through some of the highlights of the paper and discuss some of the main considerations and recommendations that we offer. The first item on plates of lawmakers when considering tax policy over the next couple of years will be the numerous tax provisions that are set to expire in the medium term. We've got a handout here that shows major scheduled changes in federal tax law, and there are a number of them. There are many major parts of the tax code that are set to change or expire over the next 8 years, and it will be enormously consequential how lawmakers choose to handle these tax provisions. The scheduled expirations will, broadly speaking, be coming in 2 waves. The first wave of scheduled tax changes is in the early part of the next decade, in the years following 2021 and 2022. And in those years, there are a number of tax provisions that are scheduled to go into effect, which would have the effect of making investment in the United States more costly. Our number one recommendation regarding these scheduled tax changes is that lawmakers should take steps to ensure that the tax code does not become a greater barrier to business investment in the United States. So, for example, currently, businesses that spend money on research and development in the United States are able to deduct the full amount of their research spending immediately. But after 2021, businesses will be required to deduct their research spending over 5 years. And this is a change that would make it more expensive for businesses to invest in research in the United States. So one of our recommendations in the paper is that Congress should look for ways to prevent this scheduled tax change and maybe substitute some other revenue-raising measure in its place. Another scheduled tax change that could, through unintended consequences, make investment in the United States more costly is a scheduled change to the business interest deduction after 2021. As many of you are aware, the recent tax law put a new cap on interest deductibility for businesses, which had certain advantages in terms of leveling out the tax treatment of debt and equity. But there's a scheduled change in 2021 that would make that cap tighter and might have the perverse effect of restricting interest deductibility for businesses that invest more in the United States. So we offer some options in the paper for lawmakers to keep a tighter cap on interest deductibility without this unintended consequence of discouraging investment. Finally, another very significant tax change that's set to occur in the early part of the next decade is the expiration of 100% expensing. 100% expensing, which allows businesses to immediately deduct the cost of their equipment and machinery, was a very important tax change in the recent bill that probably has more economic bang for the buck than pretty much anything else that lawmakers included in the Tax Cuts and Jobs Act. But 100% expensing is set to start phasing out after 2022 and is eventually scheduled to expire. And we think that it's a top priority for lawmakers to find a way to keep as much expensing in the code as possible to make sure that the tax code does not become an additional barrier to business investment in the United States. So those are some of the changes that are scheduled to happen in 2021 and 2022. Then there's a second round of scheduled tax changes, of which there are many that are scheduled to happen in 2025. And this is almost a second version of the fiscal cliff that we saw in 2012. Should Congress not take any action in 2025, businesses and households would see a large scheduled tax increase. That said, it may prove difficult for Congress to renew all of the expiring tax provisions and to make all of them permanent, just as it was difficult for Congress to make all of the Bush tax cuts permanent in 2012. So one of the important things that we highlight in our paper is that it will be important for Congress to start setting priorities about which of the expiring tax changes in 2025 are the most important to be extended and hopefully made permanent. And here too, we offer a number of suggestions and considerations. So for instance, we have the broad recommendation that Congress focus specifically on making provisions permanent that add to the simplicity of the tax code, that reduce distortions in the tax code, and that broaden the federal tax base. So one trifecta of changes in the tax bill that are set to expire are the changes to the standard deduction, the child credit, and the personal exemption. As many of you are aware, the tax bill more than doubled the standard deduction, it doubled the maximum child tax credit, and it eliminated the personal exemption. What you might not be aware is that these three changes together were more or less revenue neutral, and were sort of a structural shift in some of the tax benefits available to households that would cause more households to take the standard deduction, fewer households to claim some of the itemized deductions that distort decision-making, and that would actually make tax benefits for households slightly more progressive. One of the recommendations that we make in the paper is that given that the combination of these three changes is roughly revenue neutral, it seems like a pretty easy target for even possibly bipartisan support of an effort to make these three changes permanent, which would simplify the tax code, leave federal revenue more or less as it is, and reduce usage of itemized deductions. That's one particular consideration. Beyond that, we draw attention to the fact that some of the tax changes that are scheduled to expire in 2025 broaden the tax base, and other tax changes might have the effect of narrowing the tax base. For instance, the new limits on the mortgage interest deduction and the state and local deduction are a pretty ambitious attempt to broaden the federal tax base and to bring more income under taxation. And if Congress hopes to make some of the rate cuts permanent in 2025, it will almost certainly need to consider base broadeners like the new limits on the mortgage deduction and the state and local deduction as part of an attempt to offset the cost. So that's something to which lawmakers should give serious consideration. On the flip side, the new deduction for households with pass-through business income is a deduction that would narrow the federal tax base and might come with some additional policy issues. For instance, facilitating tax avoidance and creating distortions by placing different rates on wages and business income. As a result, we recommend that Congress take a second look at that provision before deciding to extend it into future years or make it permanent. So these are some of the considerations that we highlight regarding many tax changes that are scheduled to occur over the next 8 years. And one common thread is that it would really be better if lawmakers took action on these provisions earlier rather than later, because taxpayers deserve some measure of certainty about what the tax code will look like in the future, and as long as there is uncertainty about which of these provisions will ultimately end up being in the code, businesses and households will have difficult decisions to make, trying to game out how their future income could be taxed in a way that results from their present decisions. But beyond all of these scheduled tax changes, another key thing to remember is that the Tax Cuts and Jobs Act did not address every area of the tax code in need of reform. And in the paper, we highlight a couple of areas of the tax code that remain in need of improvement that should be the focus of future tax reform efforts. And I'll briefly highlight some of those. There remain over 100 tax expenditures in the federal tax code, meaning credits, deductions, exclusions, and other provisions that lower federal revenue by offering preferential treatment to certain parts of the economy. The Tax Cuts and Jobs Act reduced the size of many tax expenditures. It placed explicit limits on some tax expenditures, but it did not repeal very many tax expenditures outright. One easy way to simplify the tax code would be to really start cutting back on some of these provisions. They include the exclusion of health care, the fact that health care provided by employers is not taxed while wages aren't. This is a major source of federal revenue loss each and every year and a prime target for reform. They include the exclusion of municipal bond interest, the exclusion of credit unions, and many, many other provisions. Some of the low-hanging fruit for lawmakers in future reform efforts include taking a second look at the tax expenditure list and trying to scale back or eliminate preferences that distort decision-making in a negative way. Another promising area for reform going forward has to do with the tax treatment of buildings, structures, factories, office buildings, apartments. These types of business spending remain the least tax-preferred, the most tax-punished category of business spending in the tax code. Most business expenses you can deduct immediately. Under 100% expensing, you can deduct your equipment and machinery immediately. But when it comes to the cost of a building, businesses are required to deduct the cost over 27.5 years or 39 years. This creates a bias against businesses building factories and office buildings and commercial buildings in the United States, and should be a target for reform if lawmakers are looking to further encourage investment in the United States. The final area for future tax reform bills that we've highlighted in this paper has to do with the tax treatment of personal saving, household saving. The recent tax bill focused a lot on investment on the business side, but did not focus so much on saving and investment by households. And indeed, the tax treatment of household saving is something of a mess today. There are nearly a dozen tax-advantaged savings vehicles that are sort of a jumble of alphabet soup. IRAs and 401ks and HSAs and 529s and so on and so forth. Each of these has different rules, different restrictions. It's probably very confusing for the average household. And more broadly, our system of the taxation of saving is set up in a way that punishes households that save for the future, but doesn't always tax all of the returns to saving that should be taxed. So in some ways, it's the worst of both worlds. So reforming a comprehensive reform of the way that household savings is taxed to encourage saving and to simplify the tax system would also be a welcome direction for reform. To sum up, there is much more work to be done when it comes to improving the federal tax code, both in the medium term in terms of all of these expiring provisions, but also in the long term in terms of all the parts of the federal tax code that are still complex and inefficient and overly preferential. So with this call to action, I'll leave it to the rest of our panelists to discuss their thoughts about the direction of tax policy over the next 5 years, the next 10 years, and in the long run. Thank you.
Well, thank you, Scott. That's great. Excellent way to get the conversation started, and we'll start with Maddie.
All right. Well, hello, everyone. It's so exciting to see so many people in the room to talk tax reform after just passing tax reform last quarter. As Scott mentioned, my name is Maddie Doppler. I serve as a senior fellow for National Taxpayers Union, where I spend the majority of my time talking about the benefits of tax reform. So that kept me quite busy last year. And to the question that's being posed to the panel today, hopefully keep me quite busy in the years to come. And I want to leave plenty of time for discussion about the fundamentals that we can address in tax reform efforts moving forward. But I do want to talk a little bit about just environmentally what has changed. I think that there are a lot of lessons to be learned by the exercise that we just went through last year. And I also think that it would be a mistake to approach any efforts to reform the tax code in the future as if they're happening in a static timeline. Things will change with the advent of this tax bill as implementation continues, as the economy continues to respond. And nimble policymakers need to be aware of that if we hope to have any efforts to continue to improve the tax code in the future. So some of the significant changes that we need to keep in mind is that the landscape will shift radically. There will be plenty of debate about whether or not the behavior that businesses undertake in response to the tax bill is good or bad. But it would be a mistake to ignore the fact that business behavior will change significantly. In turn, consumer confidence, worker confidence, the way that workers and employers interact in the economy will continue to change as well. So we need to keep those. We need to be mindful of those things as we contemplate what can happen in the next round of tax reform, or as we ask policymakers to consider making changes to our tax code. Now, this is particularly important for those who saw the Tax Cut and Jobs Act as a significant win, as I did, and I presume a lot of people in this room did. Moving forward, we need to be cognizant of implementation and what we will see, particularly at the state level, how the tax reform bill will not only be implemented, but how conformity will be pursued. Taxation has done a lot of great work on this issue in particular, how states will continue to conform with changes in the federal code. But in my capacity with National Taxpayers Union, I've been having a lot of conversation with state level legislators and governors and people who are asking, well, what does this mean for my state? I had an agenda that I wanted to accomplish moving forward, and I'm not sure if that is helped or hindered by what's happened at the federal level. And so something that I always tell stakeholders at the state level who are contemplating major changes to their tax systems is that they should keep the faith, but do their homework. And that's something that it's an axiom that I think is understated, but needs to be emphasized moving forward. Something that I think was maybe ignored or was not fully realized until we were done with tax reform is how important the familiarity of the language for tax reform was for Republicans in order in getting this done. This is a lexicon that really is the native tongue for Republicans on the Hill and in Washington, and I think that needs to be the case at the state level if conformity is going to be adjudicated in a way that is at least seamless, but at most maybe harmless. But also something that needs to, I think an axiom that needs to be true for stakeholders at the state level if we want to continue to build on the reforms that happen at the federal level. I think that it is up to those of us who believe the Tax Cut and Jobs Act got us a lot of the way there in terms of tax reform to continue to protect that win, but we need our help from allies at the state level if we want to be successful in that effort. So the other thing to keep in mind as we move forward contemplating what's next for tax reform is that there's been a major shift for those of us who've been working on tax reform for quite some time. You're particularly attuned to this if you're a conservative who's been talking about the benefits of free market reforms, limited government, all of these kind of abstract concepts. Now we have an opportunity to make those abstract concepts a reality. So it is up to the people who have said that the public policy that we put into place will be beneficial to continue to connect those dots. And we've seen some of that in this last year. I mean, the enthusiasm that we saw at the outset in January, I certainly didn't anticipate having at this point 400, 500 employers who have announced bonuses as a result of the tax reform bill. The fact that we've seen benefits increasing by some employers, utility rates going down, all of these benefits that people are personally experiencing are important and tangible effects of public policy here in Washington. You don't get a lot of opportunities to make that direct connection no matter what the public policy arena is that you work in, but in particular on tax policy, where a lot of people like us unfortunately tend to put our green eye shades on and talk a lot about the economic growth benefit or job growth that comes from tax reform or comes from these kinds of policy changes. But having that effect take hold and people seeing that change in their household incomes is really important and is a message that needs to continue to be delivered for people to essentially trust their policymakers to continue to build on the success of tax reform as it happened here in Washington. Now, states who do conform will likely see revenue influxes as a result of federal tax reform. This is an opportunity to once again use this refractive point for states to make the case for why some of these changes are so important for fiscal prosperity moving forward. States that choose to use any of this extra revenue to continue to make their codes more competitive, I think will have the upper hand here. We've seen a lot of blowback. I don't say blowback. We've seen a lot of discussion with states who feel that the federal code puts them at a disadvantage, particularly obviously in states where the SALT deduction seems to be a particularly important policy measure. I think that we'll see a lot of measures that are too cute by half in terms of trying to address those changes in the federal code, and that ultimately will lead to a very complex situation for states that don't try to conform and use this opportunity to improve their tax systems rather than increase complexity in their response to federal changes. So moving forward, looking at what's happened in Washington, another thing that I think we need to keep in mind is policymakers up here need to continue to be engaged on this debate. Something that we forget is that our policymakers are also relatively new to this realm in a lot of cases. 2/3 of the House Republican Conference has been elected since 2010. So what does that mean? That means that now we have a conference that will likely know a more competitive pro-growth tax code than not, which from my perspective gives us a lot of inertia moving into this discussion about what can continue to be done. However, it does point out the importance of staying engaged on these topics and also giving stakeholders the opportunity to become really stewards of this effort. Tax reform itself, as I mentioned, is a familiar concept for Republicans, but in order to really ignite stakeholders and allow them to educate Americans and their constituents about the importance of these policy proposals, we need to make sure that they stay engaged and informed on those issues. So we still have a lot of runway left. I think if we have a conference, especially in both chambers, that is engaged and excited about tax reform, can recognize the wins that are coming out of that policy and use those wins to continue to promote this agenda, we'll see a lot of runway left on tax reform. There's a lot of things that still need to be done, as Scott outlined for you. In particular, the permanency on the individual and on the business side. This is something that I think is paramount to continue to see benefits from the changes in the tax code accrue. Without the stability and certainty that is garnered by a permanent tax code, we will continue to contemplate this question. What kind of space do we have left to implement tax policy that really does allow us the greatest level of prosperity with our tax system? Permanency on all fronts, everything that Scott mentioned essentially, for business expensing, individual rates, looking at what happens with that pass-through deduction and whether or not it is the best way to treat small business income. These are all questions that we need to be asking that can be solved if we commit to a permanent code moving forward. I think it's also important to talk a little bit about, what we're looking at when we see the changes that businesses are making, when we see this business behavior begin to change. There's been a lot of criticism that I think is completely unfounded on the notion that these bonuses or utility rate cuts are insignificant. They're not, especially for Americans who have not seen wage growth in the past several years. But moving forward, there are fundamental changes that are going to happen that are certainly not insignificant, but are also very important. And they're important both in the way that they are going to be realized by taxpayers, but important also for public policymakers to use these data points as we continue to talk about why permanency in the code is important. You see a lot of people, as I talked to a lot of people as this was moving forward, about the international aspects of the tax bill and whether or not territoriality is really important. In particular, whether or not repatriation would be successful. They used the example of 2004, 2005, 2006, early 2000s under Bush when we did around repatriation. And there was disagreement as to whether or not it really juiced the economy and that money went back to workers. Now, that's an honest debate to have, but the thing to realize is that we're not doing repatriation in a vacuum. Repatriation is just one component of moving to a territorial system, on top of which, when businesses repatriate their profits, they now have full business expensing to take advantage of when their money arrives here. There's now a system that is in place that induces investment in a way that we've never seen before, and it would be a mistake to allow that opportunity both to expire, but also not to make the case to Americans as to why wholesale having those changes is so important to having a competitive economy. One other point that I think that I'll make is just that one of the biggest beneficiaries of the tax law will be young people. And I think this is important for a couple of reasons. One, they'll be the largest voting bloc, probably in the next election, if not the one after that. And that's extremely crucial. If we want to build support for good tax policy, you need to have people there who have the political will to do so. But I wrote a lot about this during the tax reform debate as to why young people will be the ones who benefit from this expansion in progressive tax policy. One of those, I think, really does come back to the change in some of the business tax law that we saw with tax reform, but also just in the changing nature of work. And this brings me back to my first point about the fact that the environment is going to change. And if we continue to address tax reform as though it is happening in a static environment, we are losing the opportunity to have a tax code that actually responds to the reality of the American economy. Right now, you've got about a third of millennials who will say that they have a side business that they run by themselves. That means that a third of the larger portion of the American workforce is not only an employee, they're an employer. So the argument that we heard a lot during tax reform about how corporations and businesses are automatically, it's a binary choice between corporations and businesses and workers, is simply not true. It's not borne out by the nature of our workforce. So moving forward, we need to be contemplating, how do we have a tax code that responds to the needs of a multidimensional workforce and a multidimensional makeup of employers? I think that's a really interesting question. I think it's one that we have space to explore in these coming years. But unless we commit to having more permanent tax policy and certainty in our code, I don't see how we're able to address those factors. I think of that, I will leave it probably at that, so we have time for discussion later, but I would like to thank the Tax Foundation for posing this question to all of us. I think it's an important and interesting discussion, and I certainly think as we move forward, there's a lot of opportunity to get creative maybe on some of the ideas that we talked about today, and how we have a tax code that works not just for small portions of the economy or small portions of the American industries, but really for everyone.
Thank you, Manny. Len, you have the floor.
Thank you. Thank you for inviting me to participate in this forum. And I want to applaud Scott and the Tax Foundation on their paper. Tax reform isn't finished. I think it's definitely worth reading and very readable. I didn't bring a paper with me, but I suppose if I had a title for my talk, it would be Tax Reform Isn't Started. Now, I like tax reform. It's what brought me to Washington in 1985. They were a year plus into what became the Tax Reform Act of '86, and I was teaching about it, and I thought I actually want to be involved in this. And I worked for the Treasury Department. It was thrilling, and it was a miracle. But this isn't tax reform. This was a hastily thrown together hodgepodge that was designed to meet an artificial deadline. Now, I don't want to underestimate what probably some people in this room did to make that hodgepodge come together by the end of the year. I know it was a tremendous amount of work, and there are a lot of things in the Tax Cuts and Jobs Act that I think are good. I'm going to leave it to the other panelists to focus on those. But it's not the way you do tax reform, and I think there are problems. First of all, think back to the Tax Cuts and Jobs Act. There were 0 hearings. I know there were hearings on other aspects of tax reform, but no hearings on the actual issues that Scott focuses in his paper that actually need to be fixed. So many things that should have been vetted, and for example, the 20% deduction for pass-through income. This is a big issue, and there were people writing about it, Tax Foundation, Tax Policy Center, AEI, raising a lot of issues, and it needed a little bit more thought and discussion. For the Tax Reform Act of 1986, there were 66 hearings over the 2.5 years in the run-up to it. For the Tax Cuts and Jobs Act, it started in April with the dog ate my homework version of tax reform, a 1-page list of bullets in April, a little belated April Fool's joke from the Treasury Department, saying, we like tax reform, we're going to cut rates and do other good stuff. And the first draft of the bill that was actually enacted was published in November. I think you remember there were things handwritten in the margins because it wasn't quite right. It was signed in December. It was amazing in some sense that it could be done so quickly, but it didn't have to be, and I think there were real issues. There were, if you think about the run-up to the Tax Cuts and Jobs Act, there was good reason to reform the tax system. There were a number of challenges. First of all, we were running enormous deficits. The Congressional Budget Office projected that over the next decade, we'd have $10 trillion in additional deficits on top of our already very large public debt before the Tax Cuts and Jobs Act was enacted. Another issue was wage stagnation. I think Maddie talked about this, or people in large swaths of America feel like they haven't gotten a raise in 20 or 30 years. And they're right. And I think that was part of what motivated the support for people like Donald Trump and Bernie Sanders, because they actually were speaking to those workers and saying that they could do something for them. I think it's part of what motivated the tariff measures that the president just announced. I think those are seriously misguided, but it's certainly aimed at saying, we're going to cut down on the unfair foreign competition. And economic inequality had risen to levels not seen since the Great Depression, and I don't think that's a good thing. The corporate tax system, our corporate tax rates were the highest in the developed world. There were good reasons to want to lower corporate taxes. There also was an issue with tax shelters. So what did the Tax Cuts and Jobs Act do? First, as far as deficits go, it added $1.5 to $2 trillion in additional deficits, depending on whether you think the expiring provisions are going to be enacted or not. In terms of wage stagnation, I was thinking about it. There actually is a small boost to wages for low-wage workers. It's a little bit subtle, but when they doubled the child tax credit from $1,000 to $2,000, the child tax credit under prior law phases in with earnings. So earnings above now a threshold of $2,500, you get $150 in additional child tax credits for every $1,000 of additional earnings. Before the Tax Cuts and Jobs Act, you could, if you had enough earnings, you could get the full $1,000 tax credit, even if you didn't have enough tax liability to use the credits directly. Under this bill, it doubled the child tax credit for middle and upper income people, and actually expanded the income levels at which it was available, but it only increased it by $400 for low-income working people. This is actually odd. I mean, you think about what it does is that it helps workers with children. Seems like a group that would be bipartisan support for assisting. Overall, the bill was very regressive. Most of the benefits go to very high-income people. It cut corporate tax rates, and that's a little bit of a mixed bag. It was a huge windfall to existing shareholders. The fact that the stock market has gone up could very well just be a function of the fact that companies realize that all of the investments they've made for the last 10 years, and they thought were going to be taxed at 35%, are now taxed at 21%. That's a huge boost to the bottom line. That's not a permanent effect, though. The bill also allows expensing, immediate deductions for new investments, and that will certainly encourages new investment, and unlike the rate cut, it's prospective. It only applies to new investments and not to old ones. But there's still interest deductions allowed for, they're limited under the law, but they're not eliminated. Why is that a problem? Well, if you have expensing, then new investments are effectively tax-free. It's like putting your money in a Roth IRA, or I guess, actually more like a traditional IRA, but the economics are the same. So they're tax-free to start, and then if you allow an interest deduction on top of that, you're basically subsidizing that a new investment that would just break even otherwise becomes profitable because of the tax breaks. That is a recipe for tax shelters. The territorial system, I think there's a good argument for doing that. The rest of our foreign competitors have territorial tax systems. But there's a problem that if foreign income is untaxed, then there's a very strong incentive to make as much of your income as possible look like it's foreign income. It's going to put pressure on transfer pricing even more than existed under prior law. And the other thing is that a lot of investments will be channeled through tax havens, countries that have zero taxes or very low taxes. And there's a provision in the law that's intended to limit that, but it's a global minimum tax on foreign investment. And it could actually create perverse incentives by saying, well, if you have a lot of untaxed income in the Cayman Islands, then if you earn additional income in the UK or France, which is taxed at higher rates, effectively that's just going to reduce your minimum tax liability. It'll offset your French or British tax liability dollar for dollar. It could actually encourage more investment in those countries. It would make a lot more sense to have a per country minimum tax. I mentioned the 20% deduction for pass-through businesses. The argument for cutting corporate taxes in some ways is that corporate taxes are overtaxed relative to unincorporated businesses because they're subject to a tax at the company level and again at the individual level on dividends and capital gains. But this thing says, okay, we're cut taxes on corporations, we have to cut them on unincorporated businesses too. Well, there are a couple of problems. One is there's really not an economic rationale for it. Second, there's a huge incentive to make it look like you're earning your income through a pass-through. By the way, I'm telling you today that I am no longer an employee of the Urban Institute. I'm a contractor, which will cut my tax bill by 20%. There are guardrails that are built into the new law that are intended to prevent abuse. They're not going to work. They're not going to work because there's such a huge incentive to take advantage of this giant loophole. And there are a lot of smart people, probably people in this room, who will find it more lucrative to figure out ways to make corporate income look like, or unincorporated income look like it qualifies for the 20% deduction. And it costs a lot of money. The Tax Cuts and Jobs Act also addressed a non-problem, which was, it's a huge boost to the economy in the short run. A couple $100 billion in tax cuts at a time when we have a 4% unemployment rate, basically at full employment. It's possible that Congress was anticipating that we would start a trade war and we would need some economic stimulus, but otherwise it doesn't really make any sense. Maddie talked about bonuses and pay increases, and it's possible that over the long run, this bill will push up wages. And the way it would work is By encouraging all that new investment, companies will have more machinery and equipment that'll make workers more productive, and that will push up wages. We can have a debate about how big of an effect that is. I think there's probably a little disagreement on the magnitude on this panel. But that economically, that makes sense. In the short term, it's not going to do anything to the productivity of workers. The reason we have bonuses now, and the reason there are pay increases, is that point about full employment. With 4% unemployment, you want to keep your workers, and you want to hire new ones, and the way to do it is to pay them more. And bonuses make a lot of sense because you're not making a permanent commitment to higher wages. It's exactly what you expect at this point in the business cycle. So there is a silver lining, though, and that is that the Tax Cuts and Jobs Act could do for tax reform what the 1981 tax cuts did, which is mess up the tax code so much that there would be a lot of support for real reform. So we're asking what we should do in the short term and the long term. Short term, technical corrections makes a lot of sense. I think we should uncap the additional credit, the additional child tax credit. That refundable portion was limited at $1,400. It wouldn't cost that much. You could pay for it by ending the carried interest loophole, something Donald Trump really wants to do, but he forgot about. If you're trying to do something on a bipartisan basis, which that was a key feature of the '86 Act, and it would make sense, consider expanding the earned income tax credit for people without children at home. It's a very sympathetic group, and there are proposals on both sides of the aisle to do that. In the long term, start working on the Tax Reform Act of 2022. Put together a plan that actually raises enough money, enough revenue to pay for the government. Maddie argued that the Tax Cuts and Jobs Act was good for young people. Keep on running up deficits. That's tax increases on young people. That's a problem. We should try to reduce distortions. We should try to tax corporations and pass-throughs in the same way. The story was that Senator Hatch was working on a plan to do that. It's technically called corporate integration. And I was sorry that did not make it into the tax reform deliberations. There's a proposal by my colleague Eric Toder and American Institute's Alan Viard to basically tax all income at the shareholder level with a withholding tax at the company level. It makes a lot of sense. As far as multinational businesses go, it would make a lot of sense to have a per-country minimum tax. It would not penalize companies who are doing business in England or France or Germany, but it would keep them from making it look like a lot of their economic activities were in the Cayman Islands when they're really not. We should reform the estate tax. We doubled the thresholds for the estate tax, but we didn't deal with gaping loopholes that are built into it. And we should tax capital gains at death, which gives people a very strong incentive to play games to hold on to assets that they would otherwise like to dispose of. We should do something to really boost the wage of low and middle income workers, acknowledging the fact that the market economy is not doing a good job of that, and that's not going to change anytime soon. And we should find a more efficient revenue source. I'll be kicked out of the room as soon as I say these two words, but carbon tax. Every economist would say that carbon tax makes enormous sense. The other thing is, the Republicans should admit that they really want a value-added tax. It's like a border-adjusted, destination-based cash flow tax, except not a Rube Goldberg version of it, and it actually works. There are 180 countries around the world that have a VAT. And Democrats should understand that, they say, well, a VAT is regressive. VAT is regressive. We need to pay for government. We need an efficient way to raise revenue to pay for government. If you want to preserve the safety net, if you want to make sure that we can pay Social Security benefits and Medicare going forward, we're going to need to come up with efficient ways of raising revenue. The reason the European countries have a VAT is not because they hate poor people, it's because they actually want to pay for a decent safety net. That'll turn it over to Alex.
Thank you, Len. Alex, you're up.
Thank you, Scott, for inviting me here, and Scott for your paper, which was, I agree with Len, very informative and helpful in setting the stage for where things are. Understanding that we're 45 minutes in here, I'll try to keep my remarks brief, and so that we can have some Q&A and some dialogue. I'll start by just saying, the Tax Foundation was brave to hold a tax reform debate as the ink is still drying on the tax bill. They're testing this question of whether there's tax reform exhaustion here in Washington. Apparently there's not. where people really like pizza. I guess there's no rest for the weary. But it's an appropriate topic for a couple of reasons, and many of them were laid out in Scott's paper in his overview a little while ago. But I would characterize it as follows. Sound tax policy includes a couple of basic characteristics. In my view, sound tax policy involves low marginal tax rates on prospective activity, on work in the future and investment in the future. But sound tax policy also has to be sustainable and also has to be predictable. And I think it's a fair question to ask, will the tax code that we have written into law today for the year, let's say 2024, be the tax code written into law when we get to, say, 2028? And I think we don't know, right? We could look at the tax code as written and we could say definitely not. Provisions will expire, rates will go up. We could look at the tax code and say we can't afford it as it's written, or you couldn't afford it if it was made permanent. Other changes will have to occur. We could look at the code and we could point out some of the drafting errors that have become obvious to us in the last few weeks and months, and say, well, there's at least some changes that are going to be necessary. And of course, we should remember that since December, there's actually been 2 other tax bills that have moved through Congress and been signed into law. They can't, you want to talk about tax policy that happened without a hearing. Those are the bills that happened, I'd say, without a hearing. I'd actually disagree with Len. I'd say that there was the tax bill from December was actually a couple years in the making, dating back to efforts from Chairman Camp and others. And there were a number of hearings, maybe not on the exact legislation as marked up, but there's been a lot of discussion over the last few years about big changes to the tax code. Maybe not enough, but not zero. But there's a lot of tax code uncertainty, both in the big bill that we're focusing on, but there are other provisions that are temporary, that expired, that are reenacted, that are uncertainty. Those are both tax cuts that we try to keep, as well as tax increases that we try to prevent from kicking in. And so when I think about sound tax policy, it's not only the idea of trying to get the marginal rates low, but it's having a system that's sustainable and predictable. And one way to gauge that is to ask this question about whether the provisions are permanent in law. But in reality, there's no such thing as permanency, of course, right? And so any provision could be changed at any time. And so it's sort of a more suspicious or weirder notion of what does this mean to be sustainable and permanent. And it's in the eye of the beholder, but it's really important, because when we think about the fundamental objective, what I believe is the fundamental objective of the tax bill from December, at least as originally advertised, it was about promoting long-run economic growth. It wasn't intended as a stimulus bill, although it might be stimulative in the current fiscal year, calendar year. Its intention was, I think, to be pro-growth in the long run. And so actors in the economy who are making decisions about the long run, they're making decisions about drawing up plans to then go get permits, to then go make investments over the next few years. Those investments, they hope, will then yield profits in the years thereafter. They're wondering and speculating about what the tax rates will be on that investment. And just as Len described, just as the corporate rate cut included in part a windfall benefit on old investment, the investors of tomorrow are wondering if rates will rise. And they're going to ask that question whether the statutes are permanent or temporary. And so it's important that the policies be considered sustainable and predictable. They're certainly not predictable by the very nature of being, the necessity that Congress act in the future. And then the question is are they sustainable? Can we make the tax code in 2028 the same as the tax code in 2024? And do we want that? Is the other question, right? Do we want this code that we have today to be our permanent code? And so I think we don't want the tax code that we have today to be our permanent code, for many of the reasons that have been discussed already. or I should say maybe some of the reasons have been discussed already. I think we don't want it to be the tax code in the long run because it's still too narrow. You know, the point that Scott described effectively in his remarks. There's a lot of activity that remains untaxed. We should think more about ways to go after the exclusion for employer-provided insurance, health insurance, and broaden the tax base in that way. And that's not necessarily an advocacy for raising taxes, although I'll come to that in a second. But we could think about broadening the tax base and then using those revenues in ways to either lower other rates or make other changes to promote efficiency. Now, of course, we have to distinguish between statutory rate reductions and effective marginal rate reductions. And if you broaden the base on the income of a worker and reduce his statutory rates, you're not necessarily encouraging that worker to provide more labor income, a point my colleague Alan Viard and I have made repeatedly. But you are reducing other distortions in the tax code by having low statutory rates and a broad base. So going forward, there are questions about how we get these additional revenues in the system. That's what happens when you broaden the base. You get additional revenues in the system. And we could think about that, in a sense, in a narrow way. We could say, well, income tax reform's not complete yet because we didn't eliminate the state and local deduction. We only capped it. We didn't eliminate the mortgage interest deduction. We only reduced its cap or things like that. And so we could continue in this existing structure to move towards a more efficient system with fewer distortions, with fewer preferences, with more simplicity. And or we could think about other sources of revenue, and Len talked about that as well. We could think about other ways that are more efficient than an income tax to have the revenues necessary to fund the system. Having revenues necessary to fund the system, whatever that system may be, in other words, a system in balance in some sense, is, in my view, critically important, not only because I worry about crowding out, but because I worry about this predictability question. If the system isn't viewed as sustainable, then I think that the investors of tomorrow are going to hesitate because they're not going to really trust that the rates are going to remain as they are today, and they're going to worry that the rates will be headed back up in the future. And so, there are, Len described, there are ways, obviously, to add more efficient systems of tax codes, whether it be a carbon tax or VAT or others. And of course, there's plenty of problems on the other side of the ledger, and ways that we should be trying to constrain the size of government. But ultimately, those two systems should be brought into balance and viewed as coming into balance. Let me just conclude by saying that those remarks are sort of about how to bring the revenue in to help make the system, but there are also other taxes that weren't addressed in the bill from December that to some extent surprised me, and some of those are provisions, and one in particular, a provision from the Affordable Care Act, the 3.8% surtax on cap gains and dividends. And so if we're thinking about sort of the laundry list of items that need to be considered or reevaluated, I would add to the list that Len started, or really the list that Scott started, some of those provisions as well that are also distortionary. Let me stop there.
Great. Thank you, Alex. I'm going to stand up so I can see audience questions. We could do it. We could do an entire program on the back. How about that one?
I'll come
Should
back.
we partner up on that one?
Not if you have chicken. I'll only come for pizza.
Only for pizza. All right, so we'll have a pizza vat. I want to get to your audience questions, and so we'll go right to the back.
Hey guys, Ryan Ellis, Forbes, and this whole few other things. Wanted to get your comments on a Senate Finance Committee letter that went out about, I guess a month ago now. It was from the Senate Finance Committee majority to various credit union trade associations asking about business practices, kind of getting at the tax treatment of credit unions. You guys are looking forward on this, particularly in the larger size credit unions. Do you see that as something that we
Can I take that one? Not only is it coincidental, we're in the Senate Finance Committee hearing room, but I'm going to shamelessly plug an op-ed I just wrote that's appeared in Real Clear Markets this morning, and I make the argument that credit union exemption should be revisited. Credit unions, for two reasons. One, credit unions are, for all intents and purposes, getting closer and closer to their activities to actual commercial and private banks, but also, and you can see it in many different ways, sponsoring sports stadiums and some of their marketing practices, of the services that they offer, and so forth. But I think tax reform in some respects, especially cutting the corporate tax rate and the 20% deduction for pass-throughs, closes the gap in a lot of different ways between the zero taxes paid by credit unions and the taxes paid by commercial banks. And I think for all those reasons, we should start looking at taxing all of these institutions in the same way that we want to try to simplify the tax code. So I'll leave it at that. Anyone else with any comment on credit unions? Okay, we're going to move on. I do have a question, if I could, and that is about rules. We all have a different vision of where we want the tax code to look like. But to what extent are things like the Byrd Rule, which obviously had a huge impact on the design and composition of the Tax Cuts and Jobs Act, to what extent is it an inhibition to the kinds of tax reform that all of us want, irrespective of our particular philosophy? I'll start with Len.
It's a good question. The purpose of the Byrd Rule was actually to try to control deficits and
gimmicks over the long term, and it created short-term gimmicks.
And actually, I mean, arguably, the reconciliation process was designed to help control the budget, and the reconciliation process was what made the $1.5 trillion tax cut possible. It wouldn't have gone through if it had to go through regular order. I was thinking about that it's very hard to come up with rules that make Congress do things it doesn't want to do. And that's kind of a fundamental problem. I'd like to come up with budget rules that would require Congress to acknowledge budget constraints. Marty Feldstein, a long time ago, wrote a paper basically saying that tax reform is too frequent. I don't know that he made the argument exactly this way, but like people come to Congress and think, well, they've got to do something. They've got to make their mark. They've got to go in and change things. And it creates a lot of uncertainty because you keep on having new tax bills gets are an accomplishment. He said, I think he argued it should be like once every 5 years or once every 10 years you could have a tax jamboree when you're allowed to revisit the code, and then you leave it alone because no matter how bad the code is, it might do less damage if people understand it than if you continually change it.
Scott, how many provisions are there that you think that were affected by the Byrd Rule? I mean, obviously all the individual provisions.
Sure. I mean, at least 25. I mean, if you look through the JCT, the Joint Committee on Taxation list of provisions that are newly set to expire over the next 10 years, there are a number of them ranging from some of the big ones on this timeline to, I think, citrus expensing is expensing for citrus trees is set to expire at the end of 2027. All of those were shaped by the prohibition of raising long-run deficits under a reconciliation bill. So this was clearly a big structural factor in the composition of the legislation we saw last December. Also, if I can be signed up for the tax jamboree, much appreciated.
Anything like the Boy Scout jamboree? Alex?
I just add that there's a mixture between what's the sort of the Byrd Rule issues and then and a sort of related objective, which is trying to put 2 pounds of sugar in a 1 pound bag. Mm-hmm. In the 2001 bill, clearly the Byrd Rule played a big role. Everything was sunset on the last day that it could. Here, there's a couple other dynamics going on here. So things are being sunset to fit the Byrd Rule, but they're also trying to do more policy than they had budget authority for in some respect, and that's just another dynamic.
You looked at the economics of it. How much do you think that affected the economics, the long-term economics of effects of the plan?
Well, I mean, so on one hand, the good news is, and I think this was one of their core objectives, is they lawmakers really wanted that corporate rate provision not to be temporary because of some of these issues I raised before about sustainability, the perception of the policies being sustainable and predictable. And so in that respect, they demonstrated, they're signaling that the rate is intended to truly remain low in the long run. They don't have to vote again in order for that to be true. On the other hand, the expensing provisions that we've been discussing, are clearly temporary in nature. It's been an extender in the past. If I recall correctly, it's not in the president's budget, I think, right? It's not in the president's budget to extend 100% expensing. So there's a question mark about whether that policy, a big question mark about whether that policy will be permanent. Okay.
I think that Alex's comment earlier about having revenues that sustain the system that we want is an important one, and it relates to this debate because of the issues that we're talking about here. We have budget rules, as Len said, that are supposed to restrain Congress, but unless the political will is there, any rules that we implement tend to not work. PAYGO is another good example of this.
Yeah.
So you look at the mechanisms by which we're trying to restrain spending, and it is hard to conceive of one or two rules that might be the magic pill for this to work. I think that this augurs the need even more for budget reform. I would also argue that the strides that Republicans made in years after taking control of the House in 2011 contributed to the ability to get tax reform done. Spending cuts that resulted in basically erasing the spending legacy of President Obama were significant, and were able to make space for a discussion about tax reform that ultimately increased the deficit even. I think without those reforms, we wouldn't have been able to have that discussion among conservatives to begin with. So they are one and the same in some sense. I still find myself searching for what the answer is to that question and what rules will get us there. Tax jamboree, sign me up as well. I'm excited about that idea. Certainly biennial budgeting is something that has been raised time and time again as an idea that would get to some of those sentiments, but I think we'll see.
So just on the point of sustainability that Alex made, which again made me think back to the Tax Reform Act of '86. Tax Reform Act of '86 was the ultimate bipartisan bill. It was President Reagan, Tip O'Neill, Dan Rostenkowski, Bob Packwood, Bill Bradley. If I know this is easier said than done, of course, we're talking about limiting the employer-sponsored health insurance exclusion and mortgage interest deduction, so we're not in the world of feasibility anyway. But if future bills could be done on a bipartisan basis, they'll be more sustainable. I mean, the Tax Reform Act, the Tax Cuts and Jobs Act, whatever you think of it, it's a Republican bill, and Democrats see it in their political interest to attack it, and they will. It's just like the Affordable Care Act, which was a Democratic bill, and Republicans had started attacking it before it was even signed. The thing about tax reform is that real tax reform involves doing hard things that are politically difficult, and if both parties had their fingerprints on it, it would be a lot harder for the Republicans to be able to say, well, or Democrats to be able to say, this is a Republican bill, look what they're doing to you, or vice versa. So if you want a sustainable tax code, if you want a really meaningful reform, you've got to figure out a way to do it in a way that where both parties are working together. And it might be plausible. I mean, I think one of the best things about the last election was that it proved that a lot of the conventional wisdom about what's politically feasible just wasn't right. And it might be that you could do things like do bipartisan tax reform, even though we never thought that was possible.
Yeah.
Brian Baird with Best Corporation Association. Touching on the permanent versus temporary sustainability issue, Barrow and Berman just came out with a paper that showed that if you made all the business provisions permanent, the pass-through contribution to the economy would be just about, slightly smaller, but just about the same size as the corporate contribution. But as it is right now, with everything sunsetting, the pass-through contribution is actually negative. You guys talk about that. Sort of your views on that.
Alex, any thoughts on that?
I mean, I don't have a particular view on the paper. I mean, I've read the paper. I think it's being presented this morning over at Brookings, and I think it's great work, and it's a bipartisan effort, I guess you could say, in a sense. So maybe that's the seed of bipartisanship on tax policy going forward. But I have sort of mixed views about the pass-through provision, some concerns with it, many of the ones that Len shared. But I think that the one takeaway that I had from my first read of that paper is this question about, what's the horizon, the time horizon that we're thinking about, what's the policy. And we saw that in the debate, as politicians were arguing about the bill. Were they talking about the bill in 2018 and they were saying, no, there's a tax hike, no, there's not, it's a tax cut, and then everyone's picking the year to make their political points. And that's exactly what we don't want to have with the tax policy. And so we'd be better off with these policies and from a marginal rate perspective, being permanent. But then it just raises some other concerns as well.
Yeah, Scott?
Sure. I'd add that regardless of what one thinks about the new pass-through deduction, Section 199 Cap A, everyone should be able to agree that a temporary deduction is really the worst of all worlds. There's an example in this paper that asks, that imagines a pass-through business that's deciding whether to invest in a new research laboratory. And there are sort of these three major unanswered tax questions that apply. Number one, what's the tax rate that's going to apply to the profits of the laboratory after 8 years, after 199 Cap A expires? Number two, is the research spending that the business is going to be doing in the laboratory, is that going to be deductible immediately or not? And then number three, could the purchase of the laboratory be significant enough to push the business under the 30% of EBIT cap on interest after 2021? Three major unanswered questions that the business has no idea how to approach because they're in flux because of the tax code. And this is the type of thing that could really undermine some of the hoped for positive economic benefits of the bill. So really, however lawmakers choose to proceed with the deduction for pass-through business income, it's clear that permanence would be much better than making something another extender.
This is one example when you're looking at the landscape and how it has changed in the coming years and what we do about tax reform, where I think there is a lot of opportunity to think a little bit more creatively or clearly about this question. And that's because up until this point, we had a logjam of the corporate interest and small business interest or pass-through interest and what we do in terms of comprehensive tax reform. This was a question that started, even before the Camp draft, it was a question that didn't have an easy, and still doesn't have an easy political answer, but it was always one of the tensions that prohibited tax reform from moving forward. Since that tension has been diluted somewhat, I do think that we have an opportunity to talk a little bit more about what the solution is in order to make sure that pass-through income is treated in a way that is fairly and continues to increase the benefits that those businesses have in the economy.
Yes, sir.
A lot of the consensus among economists is broadening the base and lowering tax rates. So as a tax model in the future, do you see like the X tax being what we should go forward to, or the competitive tax plan, something like that?
Questions about the X tax and reform?
I can answer this one. Whenever I encounter a new tax proposal that I'm trying to evaluate, one of the first questions that always goes through my mind is would this proposal be part of a consumption tax base or not? And there are a lot of different designs for what a consumption tax could look like. The X tax, which is a product of Bradford and others, is a great example of one. The flat tax that was promoted by Hall and Rabushka in the 1990s. I'd be remiss if I didn't mention the inflow-outflow tax, which is a concept that's been popularized by the Tax Foundation's Steve Enton. I think that all of these sort of models of ideal tax systems are tremendously useful in evaluating what the place of new proposals are when in relation to the existing tax system. They're all sort of utopian in the sense that we're not going to be replacing the U.S. income tax wholesale any day soon, but they're very compelling normative paradigms.
Yes.
So for those who don't know, the X tax is basically a value-added tax that's designed to be progressive, and it's a really clever idea. It moves the tax system away from an income tax base to a consumption tax base, but trying to preserve the overall distribution of tax liabilities. And in principle, I mean, there's a nice book by Bob Carroll and Alan Viard that argues that you could do that. The Treasury Department looked at this as part of their evaluation of the 2005 tax reform proposals, and they concluded that, they ultimately didn't recommend it, and I think they concluded that while with an impossibly broad base, you could make an X tax that would replicate the progressivity of the current system without rates that were too high. In the real world, we're still going to allow breaks for mortgage interest and for other things, and then the rates get really high because if your base is consumption, you're excluding a big chunk of income from tax, which means that to raise the same revenue, you need to raise taxes. But I think my preference would be to model our tax system against other systems like the Scandinavian tax systems, which are a hybrid. They tax capital less heavily than labor, but they still have taxes on saving and investment and wealth to preserve the overall progressivity, but at relatively low rates. They rely more on value-added taxes. And in the case of some of the Scandinavian countries, they have a two-rate system where they've got a higher tax rate on wage income for high-income people than for capital income. But there's certainly things that should be talked about as part of tax reform.
We'll finish with a lightning round. I'll have one question for each of you. Actually, you can all answer it. Unlike the Bush tax cuts, which was a 10-year or a 9-year expiration, we've now got the countdown for 5 years, just to start the conversation on all of these expiring provisions. So what happens in the next 5 years? What does that look like? And what's the answer in 5 years?
I have learned not to make any predictions when it comes to tax reform, but I will say that unfortunately I think we will take the whole 5 years discussing that point. However, I will point out that the Bush tax cuts were bipartisan in nature and also were signed 85% of them permanent by President Obama. So maybe there is hope and somewhat of a template there.
Glenn, any thoughts?
Hillary Clinton's going to win by 8 points. Yeah, I actually did not make an election prediction, but it's very hard to predict what's going to happen. I mean, it's going to depend on part of what happens in the midterm election. It's going to depend on part of what happens in the 2020 presidential election. Again, my optimistic scenario is that if the Tax Cuts and Jobs Act turns out to create lots of egregious tax sheltering and people don't like it, that it could actually build support for relatively efficient tax reforms that actually address the real problems of middle-income people without stifling economic growth.
Some thoughts. Alex?
I think in the next 5 years there'll be a number of votes, at least in the House, on making these tax cuts permanent. I don't think there's going to be enacted legislation on these provisions from December until their expiration comes close. But that doesn't mean that there won't be tax policy in the next 5 years. As we've been discussing, there's plenty of other things, whether it be retirement security or other matters, or the extenders or whatnot. So there'll still be lots of activity, but I don't think there'll be real activity on these policies, aside, I guess, for probably some technical corrections in the near term.
Thank you. And for the last word, the guy who had the first word.
I'll be foolishly optimistic and say that maybe for once Congress will take action before a deadline because it recognizes the importance of providing certainty for households and businesses.
Scott, thank you for getting the conversation started. Thank you all the panelists for a great conversation. It's a great issue, and we look forward to talking to you next time, maybe even about the VAT over pizza with lunch. Have a good afternoon, everybody. Thank you very much.